Hello. In this video, I'm going to go over the exercise 914 that I'd mentioned in class. I think it's important stuff to cover. Some of it's review, but I didn't want to spend time in class on it. So what we have here is three different questions related to one company, Zonker Company. In the first question, we acquired the plant assets of Doonesbury Company, and we have the appraised value of each of those three items. The land was appraised at $400,000. The buildings appraised at $1.2 million. The equipment appraised at $800,000. A total of $2.4 million. In exchange, we gave up 12,500 shares of our own common stock, which had a market value of $168 and a par value of $100 at the time of the exchange. So we'll do this one first. And what we're asked for is just to prepare the journal entries on Zonker's books for each of these transactions. So this first one, we have an exchange. We're giving up 12,000 shares of our stock, and we're receiving in exchange some equipment. So do we have a rule that helps us value this transaction? And in fact, we do. We have our general rule, which is, I'll wait while you say it to yourself. Go ahead and say it. Our general rule is we value transactions at the fair value of what was given up or what was received, whichever is easier to determine. So what are we giving up? We're giving up marketable securities. We're receiving land, buildings, and equipment. Remember, we've got our hierarchy: cash now, cash later, marketable securities, everything else. In this case, marketable securities will be more readily determinable than everything else. So the value of the marketable securities will value the transaction. So we have 12,500 shares at $168 per share. And so the total value of the transaction is $2.1 million. That's how we're going to value the transaction. But if you look at the things we've purchased, they are worth a total of $2.4 million. So we're going to have to do the allocation according to the relative fair market values, like we did with our Pokemon cards on the first day of class. So we've got our relative values here. And what we need to do, okay, there's a couple different ways you can do the algebra. For me, the simplest way is to just recognize what percent of each of these, what percent of the total each of these is, oops, that was wrong, divided by that. And it's not 17 cents, it's 17%. So 400,000 is 17% of the total value. 1.2 million is 50% of the total value, and $800,000 is 33% of the total value. And we're going to take each of these and multiply them by the total value of the transaction. And so we know that the land is going to be it's going to be recorded at a cost of $350,000. The buildings will be recorded at a total cost of $1,050,000, and the equipment will be debited for $700,000. So that's going to be our transaction. So we're going to debit land, buildings, and equipment for these values. I think I have them in the right order. Land, buildings, equipment, I do. And then we're going to have to credit our journal, or credit our appropriate things. And remember, we record common stock at par. And then anything above par is going to be additional paid-in capital. So our common stock is 12,500 shares times $100 per share. And then additional paid-in capital is going to be the entire value of the transaction minus the par value. So this goes in at par, this is our plug, and these are the allocated values. So for part one, this will be our journal entry to record the value of these properties. So again, this is just our Pokemon card allocation according to the relative fair values. Part 2 This is another recognition kind of problem, kind of like we did with the first exercise we did, where we identified what account's going to be recorded for all the costs. The same thing going on here. So what happens? So we bought the building on July 6th. We expended the following amounts in cash between July 6th and December 15th when we first occupied the building. So these are all transactions we engaged in before we occupied the building, which means these are transactions that we engage in order to get the building ready for its use as we intend it. So these are going to be expenditures that are going to be debited to the asset account, because remember, historical cost is the cost that includes all the costs necessary to get the asset ready for use. So any of these costs that we would record after December 15th, after the building was occupied, we wouldn't necessarily record them in the same way, because those are no longer costs necessary to get the building ready for use. Once we move in, the building's ready for use, and any cost after that would be recorded differently. So let's take a look at these costs. Repairs to the building. So we're going to spend $105,000 repairing the building. How are we going to record that cost? Well, normally if we were already occupying the building, we'd record that to repairs or maintenance expense. But here, because it's a cost necessary to get the building ready for use, we're going to record that as a building. The construction of the bases for the equipment is our next item for $135,000. How are we going to record that? Are we going to record that as equipment bases? Are we going to record that as building cost because it's attached to the floor of the building? Remember our rule that we're going to record all the costs necessary to get the asset ready for use. Well, what asset are we getting ready for use in this case? These are bases for the equipment. This is a cost of getting the equipment ready for use. So we're going to record those bases as equipment cost. Driveways and parking lots. That's $122,000. We're going to call that land improvements. Remember, those are separate assets that are permanently attached to the land, but they're not the land itself. So those are going to be land improvements. Remodeling of office space in the building, including new partitions and walls. Again, this is before we've moved into the building, so these are going to be costs that are necessary to get the building ready for use. So that's going to be cost of the building. Normally remodeling, we'd probably just call it a regular expense, or we might record it separately as a building improvement and depreciate that over its useful life. But because this is a cost necessary to get the building ready for use, we're going to record that as building. And then the special assessment by the city on the land. So sometimes if we're going to use our land for a particular purpose, the city is going to make us pay some additional money. So it could be that because we're building a parking lot and the water, if it's going to flow differently, so that's going to create more work for the storm sewers, and so maybe we have to pay to upgrade the storm sewers in the area. Or maybe we're going to have to pay for the installation of a traffic light where normally there had just been a stop sign, or we have to do something to improve the local conditions because we're going to have more business traffic, and that's a cost that we're creating, so the city makes us cover some of that cost. Something like that. Well, that's the cost of getting our land ready for use as land, so we're going to record that as land. So our journal entry here, we've got several items that are going in the building account. Everything else is going into its own account. So for the buildings journal entry, we're going to include the 105 and the 161. Equipment is going to include the 135. Land improvements is going to include the 122. And land is going to be the 18, and our credit is going to be to cash because we're told all these things were paid for in cash. And so this is going to be our journal entry for part 2. So really this is primarily an identifying or recognition kind of question. How are we going to recognize these costs? again, recognize them according to management's intention and according to the cost necessary to get the asset ready for use. So that's that. The third question is about some equipment that we purchased. So on December 20th, after we moved into the building, so we moved into the building on December 15th, now it's December 20th, and we're occupying the building, and we buy a piece of equipment. And what do we pay? We pay $260 for the equipment, minus a 2% discount, and then we also pay freight on the equipment of $10.5. So again, how do we measure the historical cost? All the costs necessary to get the asset ready for use. Do we have to pay to get the equipment shipped here to make it ready for use? Well, yes. Buying a piece of equipment and leaving it somewhere else doesn't help us use it in our operations. We have to bring it in. And if that costs us $10.5 of shipping, then it costs us $10.5 of shipping, and that's part of the cost of the equipment. But also, we mentioned in class, if we take a cash discount, we'd reduce the cost of the asset. Now, it's only the equipment cost that's subject to the cash discount. We're not told the freight is subject to a cash discount. So what's the cost of the equipment? We're going to take the purchase price of the $260. We're going to multiply it by the discount. Actually, what I'm going to do is I'm going to multiply this by 0.98. Whoop, that ain't right. Plus that times 0.98. 254.8, so that's going to give us our discounted price, because remember, what we gave up is 254.8, not 260. And then we're going to add the freight. And so the freight is $10,500. And then the total cost of the asset in this case is $265,300. So we're going to debit equipment. I'll put it over here with the other journal entries. I'll debit equipment and I'll credit cash for $265,300. And so this is going to be our journal entry. So again, this is sort of a putting together some of the pieces, parts that we talked about. What do we call the value? It's what we actually gave up. It's including all the costs necessary to get the asset ready for use. Okay, so that's that. Sorry. So those are the three parts of this journal entry. So we are going to first, the three parts of this problem. First, we're going to do our allocation. Then we're going to do our recognition piece. And then we're going to do our measurement of the cost. If you have any questions on this, please let me know. Thanks very much. Bye.